Happy Thursday and welcome to our boot camp this afternoon on IPOs, SPACs, and direct listings.
The new reality and the new dynamic in the market is what we call the tri-path.
Where you can do a traditional IPO, you can do a traditional M&A, or you can do a SPAC.
Traditional IPO is sort of a well-oiled machine. Institutional investors are given a little bit of a discount to do the work. They also have pretty good visibility on what their allocation will be. We've got analysts hitting the phones talking about their estimates. You don't have that as much on the direct listing side.
A lot of ink has been spilled about direct listings and how they work, and really for good reason, because it feels like there truly is a groundswell going on right now and a shift in the narrative. The main implication is that a direct listing becomes a much more viable path for many different types of companies. You don't necessarily need to be a consumer brand name. You don't need to be a huge company at scale.
A private company probably goes direct listing for two reasons. The price of going public on a regular IPO is expensive, and they might feel it's expensive, and they want to preserve their valuation.
A listing is a capital raise, and it's a listing on an exchange so that your stockholders can get liquidity. And what direct listings have basically done is it's allowed boards to think of those events decoupled.
We've got a nice chart from DealLogic showing this record-breaking year we're having going back to 2000. Looks like we're probably going to top even that. But what's interesting you see here is that the total IPO amount, well, roughly 40% of that is SPACs.
The SPAC product is a reality and a focus just about every conversation and every interaction that we have.
Institutional investors are looking at this as a structure to effectively find good companies, use their unique skills to find good companies that will make very good public companies.
One thing that everyone needs to be aware of is that when you're doing traditional M&A and you're being acquired either by a private equity firm who's going to provide you some support or by a strategic, the SPAC transaction is very different because of the fact that you are the operating company.
One nice thing about a SPAC structure is you're effectively putting in $10 per share. This is typically between an 18 and 24 month vehicle. And to the extent that, at the end of life, you either get your money back, in other words, you get that redemption of $10 per share, or even in the context to the extent that, they find an acquisition, you have an opportunity to also have a redemption.
The disadvantages are you don't have the preparation time that you do that Barbara alluded to in preparing for an IPO. You're very condensed in doing that, but at the end of the process, just like an IPO, you are a public company, and there's no asterisk next to your name saying, "Hey, we became public by way of de-SPAC, so give us a break." That doesn't really exist.
SPACs that are doing a de-SPAC at the end of their lifetime, that seems to be a factor for hurry, stress, anxiety, perhaps sloppiness, and that's where we see the more important or more difficult M&A related litigation.
If you look into 2021, there's no question that the most recent situation with COVID has allowed all of us to rethink how you approach investors. The virtual dynamic has been unbelievable, because then you have access not just based on geography, you have access based on the hours of the day. So you're exactly right. You've seen these roadshows being condensed, not just SPAC IPO roadshows, but more importantly, just traditional IPO roadshows.
2021 is an exciting year. I think the pie of direct listings and the direct listings with a raise, if it gets approved, is going to be a great product. And the companies are going to access that because they want a cheaper way to go public and they want to preserve valuation.
There right now are about 60 SPACs that are publicly filed, and roughly we've been at the pace of 8 to 10 SPACs, new SPAC IPOs, right, a week.
Given the number of SPACs that are being raised currently, we expect that this trend will continue, and the number of SPACs being raised currently it's incredible, and it also involves a very high quality sponsors.
Notable about SPAC IPO pricing is how much it's gone up. There's so many, and not very many insurance carriers can actually put up a 2-year policy. So that's the dynamic. It's a scarcity situation. I just have to add that the D&O insurance market for foreign filers is actually worse than anything I've talked about so far. So one more time, be sure to talk to somebody who does this a lot so that you don't blow up your financial model at the last minute.